In this lecture, I'm going to explain all the journal entries for the partnership. I will be explaining step by step for investing, withdrawal, and methods of allocation of income. So first is investing in a partnership, then income allocation that will be based upon the different methods. The first is agreed upon the percentage, then percentage of the capital, then salary, interest, and agreed upon percentage. So these are the different ways to distribute the net profit among all the parties, means all the partners. Then partnership financial statement. Just like the financial statement for the sole proprietorship, we have the profit and loss account and balance sheet. Exactly the same way that we will have the profit and loss account and balance sheet. And plus is the statement of partners equity as well. And what is the conclusion that I will be explaining? First is investing in a partnership. Partners, which is known as owners in a partnership, may invest money or other assets in their company. Not only money they are bringing cash, but if they have vehicle, they are bringing the vehicle in the business. If someone is having some maybe truck, they will be bringing the truck. And if on the truck, on the base of the truck, if there is some mortgage, that will also come. If a mortgage or not is attached to an asset that the owner is transferring to the business, can also be transferred to the firm, right? Assets which are brought by the partners will be contributed to a business are recorded at the fair market value. Anytime a partner invests in the business, a partner receives capital or ownership in the partnership. You will have one capital account and one withdrawal, or which is known as a drawing account for each partner in the partnership firm. For example, on January 15th, Rex and John, two guys, decided to form a partnership firm. Rex contributed $200,000 cash to the partnership, and John is going to give $50,000 cash and also bringing truck with a market value of $40,000. John is also going to transfer 25,000 note on the truck to the business. The journal entry would be cash account debit $200,000 to Rex capital 200,000. So in this case, the cash contribution by the owner, and the cash is also brought by another partner, that is $50,000 here you can see. So cash is coming in the business will be debited. Truck is also a real asset, it's a fixed asset of the business. So $40,000 that will also be debited. Not payable, how much money is owed or mortgage is there, the loan is there on the truck, that is 25,000. In practically speaking, the John capital is 65,000. He has contributed 65,000 and Rex has contributed $200,000 in the business. Now, in case this is upon the wish and discretion of the partner to withdraw some money. Partner can take money out of the business whenever they want. Partners are typically not considered employee of the company and may not get paycheck. When the partner take money out of the business, it is recorded in the withdrawal or drawing account. Remember, when partners take money out of the business, owners are reducing the capital invested. For example, Rex wants to go to Mexico on beach vacation and decides to take $16,000 out of the business. And John wants to go to Scotland and will take $20,000 out of the business. The journal entry would be for the withdrawals in the partnership. Rex capital will be debited. Once that you are going to debit any capital, it means the capital, the money is the reducing and the business. So Rex capital $16,000 is debited. and cash has gone from the business, $16,000. And exactly the same way, John capital to cash 20,000. Next, we have the income allocation. Once net income, or we can say net profit, is calculated from the income statement, revenue minus expenditure is equal to net profit or net income. Net income or loss is distributed between partners and calculation is made to their individual capital account. The partner should agree upon the allocation method when they form the partnership. Now look at this. When partners calculate the profit of partnership, the amount they withdraw from the partnership assets are not expense on the income statement. So what is the meaning of this? So it means when the partners are going to calculate the profit for the partnership, the amount they have withdrawn from the partnership, right? Like for going out or going somewhere, that is not going to be calculated, right? That is not expenditure of the company. So partners are not employee of the partnership firm, they are its owner. So what are the possible allocation of the methods? The partners can divide income or losses any way they want, but the most common ways are agrees upon the percentage, means allocated on the stated fractional basis. For example, net income is $50,000 and profit sharing ratio is 40% and 60% between Rex and John. So profit distribution will be $20,000 and $30,000 between two partners. Means 40% of 50,000 and 60% on 50,000. So 20,000 and 30,000 respectively for both the partners, Rex and John. For example, so make a journal entry of the profit distribution for the Rex 20,000 and John 30,000, that two partners. So here the journal entry with the help of the first method will be income statement, means the profit that we have earned here during the period 50,000 to Rex capital 20,000 to John capital 30,000, allocated the profit and close the income summary account. So in this case, whatever the profit the company has is going to distribute among these two parties, two partners. Rex capital is credit. Credit mean money is increasing. And John capital is credit mean also money is increasing. Whenever there is a profit, the profit they are not going to take at home, but they are going to increase the capital in the partnership firm. Now, the second is a percentage of capital. What is the meaning of this? The capital means that money which is invested by the partners, both partners. Let's say Rex has invested $200,000 and John has invested $65,000. The total is $265,000. On the basis of capital, means percentage of capital. So that will be calculated by making the total of these two. And if we want to know the percentage of capital for Rex, then that will be 200,000 divided by 265,000. For John, this will be 65,000 divided by 265,000, mean total. Look at this. So Rex percentage will be 75.47 and John will be 24.53. So this is the simplest way to calculate the percentage of allocation on the basis of capital invested. Now the third method is salaries, interest and agreed upon percentage. What is that? Since the owner are not employees and typically do not get paychecks, they should still be compensated for work they do for the business. In this method, we start with the net income, give salary out to the partners, that is the partner salary. Then we calculate an interest amount based upon the investment in the business. We will pay to both partners, and then remaining amount will be distributed as agreed upon the percentage. Look at this example now. Rex is more experienced and service are valued at $30,000 for the Rex, but John is the less experienced guy. So service are valued at $15,000. 10% interest on initial capital invested. This is they have decided. Rex capital was 200,000 that we discussed, and John 65,000. Any remainder amount or remaining balance of profit will be distributed among these two parties, 75% and 25%. And this year, at the end of the period, this partnership firm knows that $95,000 the profit is generated. Excellent profit. Now, how to calculate this 95,000 profit among these two parties? So look at this. In this case, I'm just going to take some scenarios when there is a 95,000 profit, or when there is 25,000 profit, or when there is a loss. So I'm just going to explain one by one. So first is when the partnership firm have earned 95,000 profit, then how that profit will be allocated. Look at this. The net profit on the right hand side, you can see total, Rex, John, and account. Salary allowances. How much salary allowances are there? $30,000 and 20,000. This is a fixed for 1 year. 30,000 for 1 year salary compensation, right? So that will be given to Rex and 20,000 to John. Whether there is a profit or whether there is a loss, doesn't matter. Second, interest on capital. Definitely, this will also be going to be distributed. Interest on capital is a 10%. We know that the capital is $200,000. That I can show you at the back. So $200,000 is the capital for Rex, and for John is a 65,000. Now you can see that 20,000, 10%, and a 6,500, 10% on the capital invested, and total is this much. Balance of profit not yet allocated is 18,500. Now, so 18,500 will be distributed among Rex and John on the basis of the percentage they have decided. So Rex is saying 75%, and John will receive 25% of this amount, 18,500. So this is 13,875 and 4,625. So the total, what the total Rex will get? 30,000, 20,000 plus 13,875. 63,875 Rex will get, and John will get this amount. Income statement, and these two amounts will be credited accordingly. So this is the way to distribute the profit. 95,000 profit is distributed in this way. Now, scenario, second situation, if the profit is a 25,000, then exactly the same way, salary allowances will be distributed among Rex and John as per decided. 20,000, 65,000 interest on capital as per decided. Then we will be having allocation on the basis of 75% and 25%. That allocation will be for the loss. It means 25,000, that was the net profit, right? And 50,000 total this that we have to pay. A partnership will have to pay, whether there is a more profit or less profit or a loss, it doesn't matter. As decided by the partner at the beginning of the partnership firm, for the distribution of the profit, the first of all, they will be going to distribute the salary, then interest on capital, which is mandatory, and the third one, that will be the remaining amount. On the remaining amount, if there is a positive or a negative, they are going to distribute. Now here the 51,500 is the remaining amount, that is the loss. So loss is going to be distributed among these two partners as per the percentage decided, 75% and 25%. If we make a total of all these, in nutshell, that 11,375 got by Rex and 13,625 by John, and this is the general entry as discussed. Last scenario is $20,000 loss. Even then there is the loss, that you can see the net loss is minus 20,000. Its net profit means minus 20,000 means loss. So salary allowance is same, interest on capital same, and balance will be total of all these, that will be 96,500, which is divided between those two parties. Now if you make a total of this, you will find that the total here is 22,375 loss, that Rex will receive this much of loss. It means he will be giving this much amount to the partnership firm because there is a loss. Look at this figure. The one figure is which is a very important, that is the $20,000. Rex saying that the total loss that we have suffered in this firm, that is $20,000, but only mean that I am paying 22,375, and other partner John is getting profit of 2,375. So journal entry would be the Rex capital will reduce, mean debit, and income that we will write it here, and John capital that will be 2,375 that he will get. John capital will increase, but Rex capital will decrease. So transfer of profit of 20,000 to the both parties based upon the agreement. Now the next is partnership financial statement. Statement of partners equity and balance sheet. What is that? Look at this. So this is the partnership equity, partners equity for the year ended on 31st of December. Capital at the beginning it was $200,000 and 65,000 respectively for Rex and John. And for example, add profit, for example, like 40% and 60%. So 40% and 60% profit on the basis of a $50,000 profit. We are assuming that in this firm that we have earned, this organization, this firm has earned $50,000 profit, and the profit is divided as per the ratio 40 and 60. Now withdrawal by the partner $60,000 and $20,000. This is withdrawal, and the rest of the amount is capital at the end. This is what we have prepared, the statement of partners equity for the end of the period. Now balance sheet, we know that the cash balance will be $264,000. Truck is 40,000 that I bought at the very beginning, and this is the total 304. And long-term payable is $25,000 at the mortgage also brought by the John, right? So Rex and John equity is this much, and this is the total. So this is, like we can say, the balance sheet is prepared on the basis of the information available. So what is the conclusion? It is very important to choose the method of distribution of profit at the time of starting or forming the partnership deed. If you are going to start a partnership, you should have ramification of selecting the way of dividing profit earning or earned. Ramification means consequences, may be bad or a good. You should consider beforehand before starting the partnership. We have learned journal entries at the time of investing by partners, withdrawal money from the partnership firm, allocation of net profit as per agreement by using different methods such as agreed upon the percentage or percentage on the basis of the capital invested, or third method is salary interest agree upon percentage. These are the three ways for distribution of the profit in the partnership firm.